Hey traders, thanks for checking out this video. My name is Travis from Master the Market, and this is going to be an intro to options trading video. We're going to be going over the basics of options. I'm going to explain what exactly they are and how you can trade them, and I'm going to be showing you one of the biggest mistakes that new traders make in the options market, which ultimately leads them to taking a lot of big losses that hopefully you can avoid taking with your own trading. So anyway, if you already know the basics of options, like what exactly options are, you know the difference between calls and puts and those types of things, feel free to skip ahead in the video. But for everyone else, let's go ahead and get started with what exactly options are. Now, essentially by definition, an option contract is going to represent 100 shares of some kind of underlying asset, whether that be a stock, an ETF, or even an index. And what this contract does is gives that buyer the option to buy or sell at a specific price up to a specified date. Now, for the sake of this video and the sake of keeping things simple, we're really not going to worry too much about those things. Instead, we're going to focus on the fact that most people are simply trading option contracts the same way that you trade a stock. You're simply looking to buy low and sell high. And the reason that you would want to trade these option contracts rather than the stock itself is because what they do is really allow traders a more affordable way to trade high-priced stocks. And a lot of times these are going to give you a much better potential for a bigger reward as opposed to trading that underlying stock itself. So for example, if we go ahead and take the profitability chart of an option contract for Apple, over here on the right side of the screen, this is the percentage move that we're seeing in Apple. And the numbers that you see here in the middle of the profitability chart is representing the percentage move in the option contract. So just for example, if we were to see a 4% move in Apple stock here, you could see that this option contract would go up about 32.7%, which is one of the reasons why so many people are being drawn to options trading, because at the end of the day, if you're on the right side of the trade, you can make a much bigger return on your investment. Now, when it comes to actually buying an option contract, there are really two types of contracts that you can buy. Those are known as call options and put options. And essentially what a call option is the options market equivalent to going long or buying a stock. So in other words, the goal when buying a call option is to see a rise in the underlying asset, which is going to cause your call options price to also go up. That call options price is known as the premium for that option. And remember, just like anything else, you still want to buy low and sell high. So your goal with these call options is going to be to buy them low when the stock price is also low. And then as the stock price rises, your call options premium is going to go up as well. And you can go ahead then and sell that at a profit. And essentially, this is going to be the exact opposite of what a put option is. A put option is really going to be the options market equivalent to short selling a stock. So when you're short selling, the goal is to actually see the value of that stock go down so you can profit from the stock going lower. The same is true for a put option. Instead of short selling the stock though, you would buy a put option, and as the stock's price goes down, your put options price is going to go up. So again, you're going to be ideally buying those put options at a low price, and as the underlying stock's price falls down, your put option is going to go up, and you can sell at a higher price and then profit from that move. And if we take a look at a profitability chart for a put option, in this case, you can see that all of this red is up here at the top of the chart, showing us that in this case, if Apple were to go up over time, your put option is going to lose value. And that's because, again, when you buy a put option, you want the price of the stock to actually fall down in order for that put option to become more and more profitable. Now, when it comes to actually choosing the right contract to buy, whether that be a call or a put option, there's going to be quite a few things that actually come into play that are going to affect the way that your option is going to move, and that's going to affect the overall value of that option contract in general. And the first of those things is going to be the expiration date. Simply put, the expiration date is the last day that the option contract can be traded. And the reason that this is very important when you're choosing your option contract is because the closer the expiration date, the more volatility that option contract is going to have. So in other words, if you're trading an option contract that expires in maybe just a few days, there's going to be a lot more volatility, and because of that, it's going to be a much higher risk, higher reward trade than an option contract that is expiring in 3 months. For that reason, unless you're doing a quick day trade with a small amount of money, most people tend to avoid these close dated expiration dates and look for something maybe 3 months to sometimes even 2 years or more out from their expiration date. Those are going to have much less volatility than the option contracts expiring in a few days or even a few weeks, but they are still going to give you a better potential return on your investment than you would get by investing in the underlying stock itself. Now, aside from the expiration date, you're also going to have to choose a strike price. A strike price is simply the price that you would be agreeing to buy or sell the underlying asset if you chose to exercise your contracts. Now again, for the sake of this video and for the sake of keeping things simple, we're going to assume that you're not really exercising your contracts in exchange for the stock. Instead, you're most likely just buying and selling these contracts the same way that you would a stock. However, regardless of any of that, you are still going to have to choose a strike price, and that is still going to affect the way that your contract is trading. And to kind of understand that a little bit better, we're going to have to break down the options chain that we see over here on the right side of the screen into a few main sections. So first and foremost, if we take a look at the left side of this options chain, you can see that these are all of the call options, and over here on the right, we have all of the put options. So if we focus on the call options first, this section up here in this box is going to be considered in the money. If you compare the strike prices of these in the money contracts to the current price of the underlying asset, which is SPY, you can see that SPY is currently trading at $397, and all of these strike prices are below the current price of SPY. That's why they are considered in the money, because the price of the stock has already surpassed the strike price of these option contracts. The next section is going to be considered at the money, and these are the contracts that are going to be directly surrounding the current price of the stock or the underlying asset. And then lastly, we have the out of the money contracts, and these are going to be call options that have a strike price that has not yet been reached by the price of the underlying asset. And essentially, you're going to kind of just flip the in the money and out of the money contracts around when you're dealing with put options. So the out of the money options in this case are going to be the option contracts that are below the current price of the underlying asset. Again, we're going to have at the money contracts, which are the option contracts with strikes that are directly surrounding the current price. And then we're going to have the in the money contracts, in this case with put options. Those are going to be the contracts that have a strike price above the current price of the underlying stock. So I know if you're new to options trading, this probably sounds a little bit confusing, but one way to kind of just simplify this and keep track of these different sections in your head is to really just think of the out of the money contracts as a target for your investment. And what I mean by that is, if we take a call, for example, we know that when we buy a call, we want the underlying price to go up in order for our call option to also go up in value. So if we were to buy a call option right now at the current price, we could think of the out of the money strikes as our price target for the underlying stock. So we want the price to go up to 405. We want it to go to 410, 415, 420 in order for our call option to go up and up and up in value. And the same is true for put options. We're also thinking of the strike prices for the out of the money contracts as a target for the underlying stock, because if we were to buy a put option, we would want the price to fall down to 395, to 390, to 385, and so on and so forth, in order for that put option to go up in value and to make us money. Now, the reason this is so important when it comes to choosing a contract to invest in is because the in the money contracts are going to be much less risky, and they're going to provide much less volatility compared to the out of the money contracts. On the other hand, obviously the out of the money contracts are going to be a little bit higher risk, and they're going to have more volatility. So those are going to be the ones that provide traders with a much higher risk and higher potential reward. So to kind of sum up what we talked about in the previous couple of minutes, at the end of the day, when you're choosing an expiration date, the closer that it is to that expiration date, the higher the risk is going to be. And when it comes to choosing a strike price for that contract, the further out of the money, the higher the risk is going to be for that as well. So the safest route you can take when you're investing into an option, whether that be a call option or a put option, is to look for an option contract that is expiring months or even years away, and to buy a strike price that is already in the money. So to kind of help you understand why these contracts have such great risk, especially when they're out of the money, it's important to understand a little bit about the option Greeks. When you're doing analysis on option contracts, there is going to be 4 Greeks. Those are going to be theta, vega, delta, and gamma. All these do is help us determine an option contract's risk, and each of them are going to provide us a little bit of information about that option contract. Now, for the sake of this video, the one that I want to focus on is just going to be theta. Theta simply represents time decay for that option contract. And this is something that a lot of traders don't understand when they're buying a contract. Over time, whether it's a call or a put, theta is going to cause that option contract to lose value the closer that it gets to its expiration date. Now, because of theta, all out of the money options are actually going to expire completely worthless at $0.00, making them again much higher risk. So that's why if you've ever been in an option contract that is out of the money and it's getting closer and closer to expiration, you may notice that your option contract is losing value very quickly, even though the price of the underlying stock is staying exactly the same. And again, that's just going to be because time decay, since they're losing value as they approach their expiration date. So if we were to compare these two different contracts and the profitability of them, they're both for Apple and they're both expiring on the same day. The only difference is that the one over here on the left side is an out of the money contract, and the one on the right over here is an in the money contract. You can see that in order for this out of the money contract to be profitable at expiration, it has to make a much larger move to the upside when compared to this in the money contract that we have over here on the right side. So this really just visualizes the importance of choosing the right contract and of course understanding the risk of buying an out of the money contract. And by the way, this is from a website called Options Profit Calculator. It is completely free to use and there's a bunch of different tools on there for trading options. So I'll go ahead and link that down below in the description for you to check out. And it's a good idea if you're new to trading options to plug in the option contract that you're thinking of buying before you actually take on the trade to kind of give yourself an idea of how that is going to potentially play out if the stock moves with you or if it happens to move against you. But anyway, that's going to be a wrap on this intro to options trading video. Obviously, this was really just the basics of options trading, and it was a very simplified way of getting started in the options market. So if you're interested in learning a little bit more about options trading and you want more detailed videos, please make sure to let me know down in the comments because most of my trading videos are based on stocks. But if you guys are interested, I'd be happy to make more options trading videos in the future. Also, if you don't mind, please make sure to give this video a like and subscribe to the channel so you don't miss out on future videos. And if you're interested in learning more about day trading, swing trading, and even long-term investing, make sure to check out my website, Master the Market, which will be linked down below in the description. But anyway, thanks again for watching. I hope you enjoyed, and good luck with your trading.